Could you just quickly talk about what you're seeing as an opportunity in the marketing space from a venture capital or an investing perspective right now?
Sure. Marketing technology is a super important area for battery. We've been investing in this area for now the last 10 years. And in fact, about half of the dollars we've invested in enterprise software have gone into this mega trend. I'd argue in the world of enterprise software, this is the most important secular trend, is really around marketing technology. We're investors in companies like ExactTarget, Omniture, Marketo, Bazaar Voice, Neolane, Blue Kai, Sprinkler, and it's just been a really good run. And there have been other venture firms that have done very well in this space, but it's one where we fortunately were early and continue to think that maybe we're in the third or fourth inning of this overall mega trend.
Yeah, I think we find kind of fascinating from our point of view, and KBS Ventures is a corporate venture, corporate VC. So we have a whole operations, which is client-based, of course. What we think is interesting is, by all indications, we're in this beginning of a sort of this post-PC age, with mobile phone basically dominating, and mobile smartphone sales eclipsing PC sales. And the stats that I think your magazine also borrowed from Ben Evans recently, saying the next billion people to come online will do so through smartphones. So by all indications, we're this sort of post-PC place where you have this device that's ubiquitous and personal, and nobody leaves home without it, and it's got a set of expectations that come along with that experience on those devices. It's highly personalized. It's an intimate experience, and users bring that set of expectations to other experiences with media. And on the other hand, you have this great fragmentation. So everybody has, the average person in the US has 4 devices, for example. And so it's harder for marketers to have that coherent sort of contact with users. And that's where data plays a role. But it's also, as an investment thesis, we find investing in those gaps where we can connect the dots, where the company's connecting the dots, is particularly interesting, whether it's connecting the mobile to the physical in-store retail point of sale, or connecting TV to digital, or in some cases even putting semiconductors into paper to revitalize that sort of linear medium. So we don't like ad tech areas that are mature, where there's only 3 players, like ad serving. We like where there are gaps and there's transformational change happening.
And could you give us, could you flesh out one of those examples where you feel like something new is really happening, connecting 2 different parts of the marketing space to each other?
Yeah, it's we hear a lot about Internet of Things, and if you think about the mobile phone as being a sort of sensor-rich environment, with of course accelerometer and the camera and the GPS, and it's a multi-dimensional sort of object. Those sensors, as we know, are sort of moving now over the next couple of years into formerly commonplace objects in your home, in your car. Things that were dumb physical objects will become smart. So that's the IoT in a nutshell. But there's also another sort of sub-trend within IoT, which is the Internet of Thin Things, which is people doing very interesting work around taking conductive ink and small semiconductors and these very, very thin pieces of sort of so high-touch boards, and putting them into paper and cardboard, and allowing that to make not only paper interactive in a way it's never been, but also allow it to control through Bluetooth Low Energy devices. So for one company we've been looking at, it's called Navali, it's out of the UK. They're able to use conductive ink to make a Moleskine notebook, a regular Moleskine notebook, into a piano that controls your mobile phone, which is interesting if you think about its application to consumer packaged goods. If you imagine every piece of packaging having a sensor embedded in it, so you would know whether somebody picked it up or not, whether someone's near it. For CPG companies, that would be amazing, because they wouldn't have to worry about having to do a deal with Target or with Walmart. They would have some kind of analytics. Right now, there's a lot of dumb objects that will become smart in very interesting ways. That's sort of one of the things that gets us pretty excited.
It's a really interesting area. Neeraj, when we talk about pricing, it seems like that is a really key issue in technology right now. Valuations, especially in the private market, are sky high. How are marketing businesses fitting into that picture? And is it really an attractive area if everything is so expensive?
Yeah, it's this constant challenge between risk and reward that I think you have in every cycle. It's true that we're year 6 in a bull cycle, and so you have to be worried about the frothiness of this market. And in my 15 years at Battery, it's probably the frothiest time I've seen. Having said that,
too frothy?
Let me give you an example. I've seen companies that are doing well in marketing tech growing faster than companies in prior generations. In the world of marketing tech, broadly speaking, first of all, you had the first wave of client-server technology. That generation created very little in equity value. It didn't really work that well. And then let's say post 95, so we're year 20 of the commercial internet, you're seeing really companies take off. And so we ran a study, and we had something called T2D3, where companies would triple, double their revenue from 2 million to 100 million over 5 years. And we plotted 7 companies, Salesforce, Marketo, all these companies have followed this trend. And what we're finding now is that the companies that are category leaders are growing even faster than that.
Why is that?
I think part of it is trends happen quickly. I think the word gets out. Category leadership is being defined faster. Honestly, part of it is capital as well. It used to be that entrepreneurs built great products, they built great teams, and they executed in the marketplace, and that determined winning. And what's happening for the first time in the last few years is capital is being used in a very offensive way. And so if you can raise a $50 million round or a $100 million round, I think Uber is probably the best example of this, raising multiple billions of dollars to basically freeze the market. And it's very hard then to invest in whoever is number 2. As we know, all the equity value goes to the number 1 player in the space. Maybe 70%, and number 2 gets 20%. And so capital is being used to help increase the probability that the person you bet on becomes that number 1. And so that growth is driving valuations up very quickly. But I think you want to be in those companies because those are the ones that really drive your fund economics.
Josh, what's your answer? Too frothy?
Yeah, I would agree with Neeraj. It's a great analogy of using capital offensively. I don't know if it's as frothy as 2000, where you didn't really have business models established. We see many companies now. Uber is a great example. I mean, 44 billion, you could say they're overvalued, but maybe not, because they make a lot of money. But we see, we invest, we make about 10 investments per year, about half of that in new companies at the seed stage. And these used to be small rounds, about $750,000 to $1 million, and now they're up sometimes they're like around $3 million, which has been typically more of an A stage. So we see valuations going up, particularly when these companies are coming out of an accelerator that is well known, like Y Combinator. And another thing that's not reflected in the valuation is the deal type that is changing for early stage companies. It used to be, of course, as an investor, you want preferred equity, but now the more common deal type for early stage, because it's hard, I don't think it's that hard, but sometimes hard to value at a very early stage company, is a convertible note, which is a debt instrument, which is okay, not as good as preferred equity. And something else that's arisen sort of as a derivative of that, which is the SAFE. It's called it's a simple agreement for future equity, which is not even a debt instrument. It's just a promise to at some point your money will be worth something. So it's less good for the entrepreneur. In other words, it's not a valuation thing per se, but it's a deal structure that is negatively sort of inclined toward investors.
But I mean, this is definitely the most founder-friendly environment we've ever seen.
There's a lot of.
I think if you can basically fog up a mirror, you'll get a VC to give you a 500K seed check. I've never seen that before, and it's the times we live in. But the innovation that's happening now, these are major secular trends. These you don't see this that often, and so. We're in I think year 20 of a 50-year mega trend of building out the commercial internet.
As we look around, I mean, there's companies like Uber, which has been mentioned, that's getting so much press. Are there big companies right now in the tech space that are not in the marketing business, but that you think have potential to go into it that we should be paying attention to?
I mean, I'll give you my in general, if you look at enterprise technology, there's maybe $150 billion spent on software a year. There's $600 billion spent in media, right? 4 times the software market. It's obvious why all technology companies want to be in the marketing space. It's a big trend. It's a big pile of money to go after. And so I'm expecting all the major application software companies to build marketing clouds. I'm expecting the data warehouse guys, the Teradatas of the world, to really build out their plays. And so, this is one of the best areas to be an investor in, because you do have I'd say 8 to 10 companies really going after the winners in this space. And broadly speaking, value is accruing to the top of the stack in software. So I think application tiers will do very well. And so I think you'll see everyone in the fringes of technology looking to acquire or build their way in marketing tech.
What do you think, Josh?
Yeah, I mean, one of the things that I think is interesting in that regard is we see, because we're looking at companies that are sort of marketing, we're marketing and advertising, or ad tech and marketing tech are kind of merging and becoming, in some ways, less distinct than they used to be, partly because ad tech companies want to be less transactional and more SaaS-based, so it could just be optics around the business model. But one of the things that is interesting in terms of risks to some of these companies we're funding on the marketing/ad tech side is that the situation that's developing in mobile is not like the situation, so to speak, that developed over the previous 2 decades in desktop. On mobile, you have a couple of very, very large first parties, Google, Facebook, Apple, that control massive cross-device footprints, which is the secret. And it's deterministic, so at the authentication layer, you know it's the same person reliably across devices. That's massively important for marketing companies. And you have, in the ad tech space, a lot of companies using third or sort of probabilistic matching, which is more about statistics and confidence levels. And they've, between them, hired all the data scientists in New York City. One of the risk is that as Internet of Things, or as devices, as Google and Apple have cars and homes that are connected, and people become more concerned about security, which they are, and you see this happening, there'll be this first-party lockdown kind of happening, where it's not as easy as an outsider company to get into these ecosystems. And you see that already with Google in some cases. The Google ad stack doesn't work so well necessarily with the independents, whether it's attribution partners or it's ad servers. And I wonder if that's going to increasingly happen because there's no non-proprietary standard identifier for users across devices. The cookie did that on the PC, and it was not owned by anybody, and was regarded sort of generally as fine, the third-party cookie. That's not really relevant to mobile. So what we see are the first-party identifiers helping sort of capture that market share in terms of marketing dollars. Facebook, most famously, 2/3 of their ad revenue is mobile. I wonder if that's going to creep into the marketing space as there's more and more sort of platform lockdown.
And do you think that Apple will become a larger player in the ad space? They've made such a point about user privacy as they collect data. It strikes me that it might be a risky venture to invest more in their marketing business. What do you think?
I think Apple's, it's foolish to predict what Apple will do in some cases, but they certainly have I think they've been very, very good with removing device identifiers like the UDID in favor of a user revocable ID like IDFA. And they're pretty strict about that. And they're very serious about this encryption, I think, of the device, which has the government up in arms. So it's very user-centric from that regard. They do have, obviously, a lot of data, especially now with Apple Pay, connecting everything you do to purchases in the real. So they're in a position to not only know what kind of content you view and what sort of ads you see on the mobile devices, but to know where you buy things and to make that close that loop in a way that's very, very interesting. So I can't imagine they're not thinking about that.
One more question, and then I'd like to open it up to the audience. If you were advising some of the marketing firms that you're looking at in the way that you would just a general startup, do you feel like there's a piece of advice that Silicon Valley understands very well that marketing firms on the East Coast do not? What would you tell them? And do you want to start that off, Neeraj?
Wait, were you talking about the CMOs specifically?
Yeah.
So I think the key piece of advice I would give for the entrepreneurial CMO is this is an era where you really need to try everything, and there's maybe 1,500 companies in the marketing tech Lunascape chart that you see, and unfortunately it used to be that you could get away buying one vendor to do everything, and buy SAP or Oracle to just do everything for you. But at this point, because you need to acquire traffic and convert that traffic better than your competition, you really need the best tools. And I think what Silicon Valley does a very good job of is experimenting and trying. And I think this entrepreneurial CMOs have to do that. It came up in the last panel. This silo issue is a real issue. Email, social, mobile. At the end of the day, the customer journey is what's going to be the most important thing. Mobile is going to drive that, which is as important as a mobile native app on your phone is really the way mobile connects all those channels together.
But at this point, CMOs are trying to increase simplicity of their lives and decrease the number of partnerships they have, right? So how do you balance testing everything with the need to streamline?
And one of the areas that we've been seeing growth in is this kind of concept of a chief digital marketing technologist. And I believe that will become an important role. It's kind of a bridge between the CMO and the CIO because it is overwhelming.
Under the CMO or equal to the CMO?
I think it will be under the CMO. And I think it'll be dotted line to the CIO. I think we could end up in a world where you could see the CIO dotted line into a CMO as well. It's an exciting time to be a CMO. There is so much change happening. If you don't embrace it, I think either you're going to be a very powerful CMO or you're going to be out of a job. And you have those two choices. And so I think you should pick the powerful path. Go ahead.
I think in terms of the CMO and the teams under the CMO, I think there needs to be, you need to think about having people who are technically creative on the staff or come from an analytics or / technology background. It's not easy to compete with Silicon Valley for engineering talent, and I'm not suggesting every CMO needs to hire a team of data scientists or developers. But there is a certain ethos in the Valley, and I think in certain parts of Silicon Alley here in New York, and in Boston, of course, where people who are engineers and highly creative and entrepreneurial are prized, and that sort of creativity is valued very much. And I think that is, and you see, of course, the world's most valuable companies being, in some cases, headed by former entrepreneurs who are, at root, developers, engineers, like Mark Zuckerberg. I think that ethos is very, very important if you want to attract the kind of person you want to work with you as a CMO, because an organization can't pretend to be interested in technology like the bright shiny object kind of thing or the latest new gadget. It actually has to embody that in how it hires and how it thinks about digital marketing, and that's a challenge for a lot of large brands that we work with directly sometimes. And to have those people be interested, because you need those people to be able to do these things in this rapidly evolving digital media space. To attract that talent is not easy, and you have to authentically prioritize and make it a safe, good place for people who are creative in a technical way.
And if you don't have that background yourself, how do you do that? Is it just hiring a deputy who has that experience, do you think?
Yeah, I mean, either I think CMOs will increasingly have that experience themselves,
okay.
And if they don't, they will hopefully have the wherewithal to hire somebody who does, even if that person is smarter in that
and ultimately
area.
Puts them out of a job.
Ultimately, yeah. I mean, that should be your goal, right? Is to get to hire your replacement and then move on from there.
Let's see if the audience agrees with that.
Yeah.
Let's get the first question from right here, please.
Thanks. Hagen Benzek with Freestyle Consulting. I was wondering, how much do you think that these companies, very successful companies in the startup space right now, are really creating value versus just exploiting the weakness and the immaturity that marketing is still in? Because we heard in the panel before, very often, we're still learning. You need to experiment. You need to look at 1,500 different companies in the Luma space. Is that really something value adding, or is it more exploitation of a current opportunity?
It's an excellent question.
Let's just look at software in general. I've been studying software for over 20 years. I think there's always a role for software from a business process automation perspective. And what's changing now about the workflows is that they're really kind of data infused in a way that you never had before. So I don't view it as an exploitation. I think that there's going to be it's at steady state. I think large companies are going to need technology vendors to help them manage their digital footprint and bring it together and increase their acquisition of traffic or conversion of traffic. And those are going to be the two key things that they're going to need to do well. Technology is going to play a key role. Their ability to build that technology versus buy it, I would assume they're going to be better at buying it than building it. And so I think of it as your standard kind of healthy, buyer-vendor relationship.
Josh, could you mind talking a little bit more about whether there's some credence to that exploitation point right now?
Exploitation. I think what we try to do. You mean on the back,
in terms of basically the immaturity of the market is. Yeah,
right. The Lumascape, that's a good example. I mean, you have a cottage industry property. There's a new Lumascape every year for some new subcategory within ad tech. And then there are, I mean, generally with ad tech, the evolution is that you see a lot of players in the space. People start to complain about it being overfunded, overcrowded, and consolidation does inevitably happen, and you end up with 3 major players in a particular subcategory. In ad tech, like in ad serving, you have like 3 players, and attribution, you have 3 players. 2 of them are owned by AOL and Google. And I think that it's possible for exploitation to happen. I think what's key is to have somebody within the CMO's group who is adept at vetting and partnering with the best sort of technology partners. Because there's no denying that you need these tech partners. You just need to not spend a lot of money figuring out which one in a particular area that you're going to work with. And I think part of that is having someone with experience who can say, okay, in terms of partnerships, if we're going to go that way, we're going to focus on these 3 core areas, and we're going to look at these 6 companies in each area, and we're going to put them through a process where we evaluate them, and then we're going to come out the other end with our partner. And that process can take a couple months, it can take half a year, but it doesn't have to be throw it against the wall and see if it sticks kind of approach. I think you just have to be smart in how you approach it.
Let's take another question.
Thanks for an interesting discussion. So I see inside the retail store, you have mobile point of sale coming, and all the things you talked about, marketing tech, ad tech. It's mainly on the digital side. What else do you see happening inside retail store in terms of technology?
Good question.
One of the areas that we've seen early experimentation is really around the whole kind of beacon category. I think it's still pretty early. That's I don't know if you consider that part of digital or analog. That's an area we've seen some traction in. That's the only one that I've seen kind of in the actual store. The rest of it is all, part of the digital bucket. I put anything on the mobile phone as part of the digital bucket. I don't know if you've seen.
Yeah, I think the stores are fascinating places for experimentation in this overlap of physical and digital. I think beacons are the most, is one of the predominant areas we read a lot about. We see also some things happening with interactive displays. People like to go into stores, right? Like 95% of commerce is still in actual stores. And it can be a great experience the physical space is wonderful. It's particularly when that space can be, your experience of a physical space can be connected somehow to your digital experience. And so, for example, there are companies that will do, you put a shoe and there'll be a projected or an actual tablet surface that will react to the user actually picking up a shoe or looking at the shoe for more information, or it could be, and these are cloud-based, server-side based interactions that rely on sensors in the tablet or the camera, but actually can make that experience way more interesting than it just being a normal analog experience. So I think the display of items, the information about items, that sort of experience of the sort of the sensual aspects of being in a nice store will be an interesting area to watch too.
And what about wearables, the Apple Watch? There's an event next week. Do you expect, iBeacon technology has been really slow to take off with smartphones. Do you feel like wearable devices and smart watches are going to change that, Neeraj?
I'm not totally sure about. I think over time there will be more and more technology, that we all have with us. The iBeacon side, it's very hard to transform these stores, and so I think it takes a while for that to happen.
And
the venture community as a whole, I think, was a little bit early, and I think so far hasn't seen a lot of traction. But 10 years from now, I think they'll be there. And I think wearables will also do generally well. I think you're just seeing this technology end up pretty much everywhere.
Yeah, I think wearables are fast. I think if you're an apparel company, wearables are like the really, really exciting thing. Nike or Under Armour, these sensors that, like heart rate monitors and GPS sensors, would presumably go into the clothing that we wear in interesting ways, and that's pretty exciting. I agree with on the beacon side. There's been low adoption because one, it requires hardware to be put in stores, and two, it requires some kind of usually some kind of app on the user's phone. So does somebody want to download a retailer's app? Not always. A third-party big box app, maybe not. So you have to have massive adoption on both sides for that to really be a viable kind of thing. I think that will over time emerge, but it's certainly in its early stage.